Hey guys, it's Derek and welcome back to my channel, and in this video I'm going to just give you a few reasons why day trading may not be the right thing for you to do. And before I start, just a quick disclaimer, just remember trading the financial markets can be risky. You should always seek the advice of a qualified financial professional. You should always make an informed decision based on your personal circumstance and your risk tolerance, especially when it comes to short-term day trading strategies. It's not for everybody. You've got to be able to deal with the fact that you can potentially lose all of your investment and maybe some more. So don't rush into it. And just remember, most important thing in this video is if you lose your money, don't blame me. Now on with the video. In terms of day trading, whether it's 1 minute, 5 minute charts, 15-minute charts, 1 hour charts, daily charts, it doesn't matter. The success of a day trader in the long term hinges on what's going on up here. Trading psychology makes up 90% of a trader's assets or skills, so to speak, because once you've mastered the actual technicals of it, it's all got to do with your ability to follow your trading plan, get out of your head and just follow the rules. The number one way of losing all the money in your account is to break the rules because you think that this particular trade is not going to follow the same pattern as all the other trades that you've seen. The reason why trading psychology is so important is because, as we all know, we all hate losing money. It's nothing worse than buying something and realizing it's going to go down in value as soon as you bought it. And this is exactly what happens in the stock market, in crypto, in currencies, commodities, futures, everything. We hate losing money, and losing money in the stock market happens in two ways. There's the real loss. So basically, if you buy a stock at $100 and it falls to $70, you've lost money, right? But we don't think about the other aspect of losing money as well. It's the FOMO loss of money. That's basically, you buy a stock for $100, it goes up to 120, you hit your profit target and you sell, only to see the stock go to $200. And what does that do to most people's heads? It makes them want to break the rule. They go, oh, screw this. The profit target was rubbish because I only made 20%. I could have made 100% if I kept hold of the stock. But what happens is you've broken your rules. You're just gambling now. You're letting things just happen randomly, and you may be successful on another trade or two, but over the long term, by breaking all these rules, you are going to get burnt. If you start treating trading like a casino, you are always going to lose in the long term. There's a chance that at the start, you may snag a couple of good cards, you may get a good roll of the dice, and you may start making money. But why do casinos always come out on top at the end? Because people don't know how to stop. People will keep betting until eventually the odds catch up with them, because if you look at it in a casino, the odds are always in the house's favor. Even with a roulette wheel, it's not a 50-50 chance whether you get black or red, because there's the 00 and the 0. The house always has advantage. And if you are greedy, you're always going to lose at the end. And what about stop losses? Do you know what a stop loss is? Basically, a stop loss is when you plan a trade, you set a certain threshold below which or above which, depends if you're going long, which is you're expecting to go up, or short, where you're expecting the stock to go down. You set a threshold where if the price hits that mark, you're out of the trade no matter what, even if you lose money. Now, psychologically, that doesn't make sense to some people because they think, why would you sell a stock when you've lost money? Shouldn't you just hold on to it until it comes back? Now that's really good in theory until the stock doesn't come back and it continues to fall. So you buy a stock for $100, you set the stop loss at say $90, you don't follow through with the stop, it falls to 85, you go, oh dear, it'll come back, and it falls to 80 and you're just paralyzed with inaction. So it goes to 75, 70, 65, 60 and you're still holding the stock. Now, don't laugh, it happens all of the time. People think, oh, don't be stupid, I'll hit 60 and I'll get out. The more you lose, the harder it is to sell because you're hoping that it's going to come back and you've lost so much money now, you just don't know what to do. And it eventually falls to $20, you've lost 80% of your money. And that reminds me of the next point. Never invest in the stock market any money that you can't afford to lose. So you do not take out a second mortgage. You don't borrow money from the bank. You don't borrow money from your aunt to invest in the stock market. When you feel the pressure that you have to make money and you have to make it back quickly, you start making dumb trades. And I know this because we've all made dumb trades. We've all tried to be greedy. We've all tried to maximize our gains, and we've all broken our trading plan. But when you're dealing with money that you're owing other people, it compounds a problem so much. So never, ever invest any money that you are not prepared to lose. So part of getting rid of this gambling mentality is to get rid of this whole FOMO thing. You may see in social media people who have made zillions of dollars trading Bitcoin. They're now sitting on an island drinking cocktails, trading an hour a day. They drive home in their Lambo to their 9-bedroom villa. That is few and far between. 99.99999% of traders lose money because they're aiming for stuff like this and they're making irrational decisions, trying to make money way too quick. You know, there's nothing wrong with earning 10 or 20% a year. You don't have to earn 100,000% per year. The less money you have, the harder it is to make money. If you invest $1 million in a share account and you make 10% a year, that is $100,000. Most people can live on $100,000 a year. But if you've only got $1,000, you have to make 100 times your money to get $100,000. So what's that going to make you do? It's going to make you take risks. It's going to make you have ridiculous profit targets. It's going to make you leverage. It's going to make you make really bad decisions chasing the big buck. And as I keep saying, if you get greedy in the stock market is going to take your money, because the market does not care about what you want. It only cares about supply and demand. And if you don't trade rationally, if you don't accept that you're going to lose trades, and most professional traders who do it for a living are successful maybe 60 or 70% of the time. So even the very best ones, even if you say 80%, they're getting 20 out of every 100 trades wrong. As a beginner like me, I'm probably getting about 50% trades right. And so you're getting half right and half wrong. Now, you might say, well, you suck. But if you think about it, in baseball, if you get on base 3 out of every 10 at bats, so 30 out of every 100, you make it into the Hall of Fame. So 50% ain't bad, as long as you've got good risk management. And this is where it comes down to the whole risk-reward ratio. You do not risk $10 for $5. It just means you have to be really successful. You're going to have to get a lot more trades right than wrong to make money. But if you're 50-50, so you get 50 trades right out of every 100 trades, and you've got a risk-reward ratio of 1 to 2. So you're risking $10 for $20. So your 50 trades, you're going to lose $10 each. 50 times 10 is $500. But in the 50 trades you win, you make $20, so you make $1,000. So at the end of the day, you're $500 up. And that's by being 50-50. So you don't even have to get the majority of your trades right. But having good risk management and good risk-reward ratios, you're going to make money. Now, something that I've been guilty of doing, and I don't do it anymore, at least I try not to do it anymore, is something called revenge trading. So you've lost 4 trades in a row. You think you had your trading plan correct. You got loss. You've only lost a little bit because you've got good stop losses in, but you're still frustrated. How is it possible that I got 4 wrong? Just remember, in terms of any type of probability, if you flip a coin 100 times and the first 99 times comes up a heads, the chances of getting heads on the 100th coin toss is still 50%. The probability doesn't change. That's not how it works. You've got to stick to your plan. You can't revenge trade. You can't say to yourself that I've got the last 4 wrong. This one's guaranteed to say I'm going to just chase it. You don't have to make a trade. So if you're in a situation where you've got a strict set of criteria, for example, you only go long if the price is above the 200-day moving average, and you've got to make sure that the stochastics have crossed over, and you've got to make sure, for example, that it's touching a trend line, it's going to bounce off a trend line. If you've got all these conditions, you can't just all of a sudden decide you're going to throw all that out the window because I've lost 4 in a row, I've got to make my money back, so I'm just going to do whatever and make some quick bucks because that is going to guarantee you 5 losses in a row. Never trade with money that you can't afford to lose. I think I've already gone through that. And never, ever, ever leverage your investment unless you know what you're doing, because yes, it does increase the amount of profit you make, but it also drastically increases the amount of money you can lose. And when you get a margin call, which means they come and fill your cash that you haven't even got into your account, that is a nightmare. Some people make a lot of money from the market by scalping. So they're taking 1% gains, they're very good at it. They're doing high probability trades or making 1% gains. But have a think about this before you do these scalping strategies. You've got to make sure that the spread, which is the difference between the ask price and the bid price, or the buy price and the sell price, is not so high. When you trade stocks or commodities, there is a middle person who takes a little bit of commission. So even if you ignore that person for a minute, someone's going to be offering, say, apples at $1.02, and someone's going to offer wanting to buy them at $1. So there's a 2 cents difference between what somebody's prepared to pay and what someone's prepared to sell it at. It's all about supply and demand. Sometimes somebody will come in and decide that I'm going to sell it for $1. Sometimes someone might say I'm prepared to pay a little bit extra. But there's always going to be what's that spread. If the company who's allowing you to make these trades, i.e. the middle person, adds a commission to that, which could be 1% or 2%. For example, the spread becomes from $1 to $1.02 to $1 and $1.04. You've already lost 4% of your investment the moment you hit the buy button. So you can't make 2% scalps because you've already lost 4% as soon as you started the investment. You're going to have to make 4% just to break even. So be really careful with spreads. Never trade when you're busy and you can't watch the market. Never trade when you're emotional, when you're angry, when you're annoyed, because that's when you're likely to make trades that break the trading plan and it's going to cause you to lose money. Remember, you don't always have to be in a trade. You only trade when your trading plan and your indicators suggest it's time to get into a trade, and you sell or you get out of a trade when your trading system tells you to get out. Holding trades overnight brings a whole new set of its own problems. Many of the brokerages will charge an overnight fee, especially when it comes to CFDs or futures or options, so you actually lose money without having to do anything. And the other problem is you've got to be careful that when markets close and there's news after hours, the market can gap against you. So what basically that means is if a stock closes at $5, it doesn't necessarily mean that as soon as it opens the next trading session, it will open at $5. If there's been some really bad news, for example, if there's been a massive profit downgrade overnight, it may open at $4.30. Even if you have a stop loss, it can gap down. For that example, if the market closes at $4 and you've got a stop loss at $4.80 and the market opens at $4.30, you're going to sell out at $4.30. So that's way below what you were prepared. And that's a reason why day traders don't hold their trades overnight. Don't expect that news will necessarily move the price in the direction you think it should. People smarter than you will have already known and factored into the price of an asset before it becomes general knowledge. So for example, if a company X announces a 50% jump in its profit, you go, why did the stock price go down? Because there are people, institutions, insiders, whatever you want to call them, who already knew that was going to happen. They've already factored that in. They've already taken their profit. Start your trades small. Use tiny amounts of money until you get used to it. I've always been an advocate that paper trades, demo accounts, do not simulate trading in anywhere near as close a way as a lot of people think. Purely because it's easy to lose money when it's not your money. If it's on paper, if it's a theoretical amount of money, you're more likely to be able to do bigger trades, you're more likely to take bigger risks because it doesn't matter. So start small, even if you trade with $100 or $200. Set limits on how much you're prepared to risk per trade so you can stay in the game. The trick about learning how to trade properly, from my experience, is to preserve your capital, because if you run out of money, you can't practice, you can't trade, you can't ever be successful when it comes to trading. And you know what? It's really hard to be patient when you're trading. You won't always be staring at the screen. It goes up by 1 point, goes down by 1 point, and you're stressing out. But if you've got a good system with stop losses and take profits in place, you could theoretically make the trade, go out and have a cup of tea and come back. If you look at a chart, you will see that the price kind of ranges around, jumps around a bit. If you're going to get stressed by every single move, it's going to be a very stressful activity that you do. So as long as it's going in the rough direction of what you want the trade to go, just leave it alone. Stop checking it. I know it's really hard. I keep staring at the chart as well, but you just got to stop because it'll drive you nuts. One thing I've found too, especially when you're a novice trader like myself, is it's really easy to get caught up in your day-to-day fluctuations in the worth of your portfolio. Instead of worrying about whether you're making money or losing money at the start, concentrate on mastering your techniques, testing, backtesting, adjusting, tweaking your trading plan if you feel like there's a flaw in it. Trading is all about patience. Even though we're trading for the short term, we want to make money in the long term. We want to set ourselves up that we can rely on our system, because if you start off with $200 and you've only lost a couple of dollars, that's not too stressful. But as your trading account grows and as your risk increases, not in terms of the techniques, but in terms of the amount of money. If you have $1 million portfolio, you're not going to be making trades worth $200. So as the amount you risk per trade increases, you need to have faith and trust in your trading system. And the best way to learn that is at the start when you're trading with $200, not when you're trading with $1 million. And if you can, find a trading platform that allows you to trade both sides of the market. Most places only allow you to go long, which means you can only invest in assets which you think are going to go up. At this moment in the markets, with all the stuff going on in the world, the markets are falling, and the only way to make money in a bear market is to be able to go short. Not only is it possible to make money in a bear market, it also helps you to protect longer term assets, the ones that you want to hold for a long time, because if they're falling and you don't want to sell them, you can actually use short instruments to protect them because you're making money with a short instrument whilst the underlying asset is falling. And that's one way that you can hedge your portfolio. And we've all heard about futures and options, leverage products that help accelerate the gains. The problem is, if you don't know what you're doing, these instruments help to accelerate your losses. And sometimes with leveraging, you can actually lose money beyond the amount that you've invested. These are called margin calls. The bank or the institution actually comes after your other assets. And this is one thing you want to avoid at all costs when you're a rookie. So that's pretty much the end of the video. As I said, I'm only a novice trader. I've only been doing this for 8 months, and I've already learned a load of stuff, and I just want to share with you guys so you don't make the same mistakes. Because there's no reason for you to be losing money on mistakes that other people have already made that you can learn from. Trading psychology is actually something that is really hard to master, because your emotions always get in the way, because you're a human being. It goes against every fiber of your existence to accept that it's okay to lose money, but that's the reality of day trading. You lose some, you win some. You just got to win more than you lose, and that's how you become profitable. Right now I'm having some okay days and having some really crappy days, but what I've managed to do by controlling my emotions as best as I can and having a trading plan is, so far, touch wood, I've avoided days where I've lost a huge chunk of money, which is above and beyond the amount that I was prepared to lose in the first place. And that's because I didn't gamble, I didn't revenge trade, I didn't ignore my stop losses. Yes, sometimes you look at the chart and you kick yourself and you start second guessing yourself because the moment you've sold something, it's gone up. But that's the nature of the market. You can't catch the peaks and the troughs. You just want to be in the trend. You just want to make your bit of money and get out and leave some money on the table for somebody else to make. Because if you're trying to pick reversals, you're trying to pick the top and you pick the bottom, you're going to be unsuccessful way more times than you are successful. And that's not how you make money. The whole point of trading is to make money, not to be right. You follow the market, you follow the trends, and that's what I'm trying to do. Let me know in the comments below how you're going with your trading, or if it's something that you find it's too stressful for you, because it's perfectly understandable, because it's actually a really potentially stressful thing to do. I actually think it's fun, but it is really stressful. If you like my videos, so like and subscribe, and I'll catch you next time in another video. Happy trading, stay safe, catch you next time, bye. Don't look at too many assets or trade too many of them at the same time. You need to maintain your focus. I've actually been concentrated recently on just trading the NASDAQ 100 and trying not to look at too many of the other things, because it dilutes your attention and you miss opportunities. The reality is, if you're looking at just particularly assets like the NASDAQ 100 and there's no indication from your plan, you should just sit out. It's not necessarily go chasing other trades, because the minute you start looking for other things, you start having 200 stocks that you're watching, you must find a trade. That's when you start getting into that gambling mentality that you've always got to be in. This is short-term stuff. This is not an investment. You're trying to make money in the short term, and you only enter when your trading plan gives you a signal to enter. You don't always have to be in the market when it comes to short-term trading. You're only in when technicals tell you should be in. Investing and trading are different, and the mentality is different. If you don't feel like you can sit out, and if you don't feel like you can follow your trading plan, you shouldn't be trading. You should be just buying stuff, holding them for the long term, using dollar cost averaging, making money, and hopefully beating the market in the long term with the investment. There's many ways to make money, but there are even more ways to lose all your money.